Hey guys, welcome back to the channel. Supply and demand is one of the most popular trading systems among traders. It can be regarded as one of the most profitable strategies that one can use to trade the market if done right. As you all know, the stock market is where traders buy and sell assets. The movement of the prices is due to supply and demand forces. Now, once you understand the dynamics of these two forces, namely supply and demand, you will be able to anticipate almost every price movement on any price chart. You will be able to track the smart money without doing extensive quantitative analysis and crunching all those data in your Excel. This video aims to give you all the necessary tools you will need to master supply and demand in the market. This topic will have two video parts. In this video, you will learn the core ideas on how to identify, draw and trade market imbalances like professional traders. And in the upcoming video, we will learn how to filter supply and demand zones using odd enhancers, which will help you eliminate low probability zones and keep only those with high odds of success. Now, the objective of this video is to help you implement this particular trading concept correctly so that you can become profitable in the long run. Now, the video will cover the following topics. We will start with what exactly is supply and demand, and we will understand what a market balance and imbalance is. Then we will talk about how to identify supply and demand zones in the chart, and what are the different structures of supply and demand zones that you will see in the chart. Then we will learn how to draw the supply and demand zones and how to trade these zones. And finally, we will identify the supply and demand curves and also learn about why it is important to identify the curve in the first place. So without wasting any time, let's jump right on it. So what exactly is supply and demand? The supply and demand concept states that if the supply of a stock or a commodity is high and its demand is low, this will generate excess supply which will drive the prices down. And if the supply of a stock or a commodity is low and the associated demand is high, then this will create a scarcity in the supply which will push the prices even higher. For example, during times of uncertainty and fear, similar to one with Ukraine-Russia war, the investors will reduce their exposure in the equity markets and start buying safe haven currencies, or they turn to low-risk investment options like gold, government bonds, etc. to protect their investment. So in such a situation, the demand for these asset classes like gold and safe haven currencies will drive their prices even higher. Another example is when the Fed or the Federal Reserve decides to increase the interest rates. What it does is that it will make the US dollar more attractive to the investors because of the increased interest yield. This is also known as a carry trade, where traders buy the currencies with high interest rates and sell those currencies with low interest rates. We have seen this recently when Indian rupee traded against USD at an all-time high. Now, having understood the supply and demand concept, we need to define supply and demand zones and understand how prices moves on the chart. Basically, a supply zone is located above the current price where there is a strong selling interest. At a supply zone, sellers exceeds buyers and price moves down as unfilled orders get absorbed. So when price reaches this level or zone, the orders get filled and the prices starts to move down. And traders are usually selling at these supply zones. And as you can see on the chart, the price rallies to a certain level or a zone, then it pauses for a little time and then retraces back down. So as long as unfilled orders are sitting in this zone, prices will keep coming back to this supply zone until all these orders are filled. Now, talking about a demand zone is a price area below the current market price where there is a strong buying interest. And at the demand zone, the buyers exceeds the sellers and the prices goes up as unfilled orders get absorbed. So we can see a lot of buying interest in the demand zone. This is most likely caused by a large number of buying orders at that level. And the traders are buying at demand zones. Most often when the price reaches the demand zone, some of these orders get executed, and what you will see in the chart is a sharp move towards the upside as these orders get filled. Now, when it comes to trading the market, many traders rely heavily on technical indicators and market sentiment to spot the shift in momentum, while there are other traders who simply trade the market imbalances by searching for supply and demand zones. Now, this term is very important, imbalance. I will talk about it in a short while. Now, these zones that I have discussed are actually price levels created by banks and institutions where unfilled orders are waiting to get filled. Now, the whole concept of supply and demand is centered around finding the smart money orders on a price chart. It is simply because they have the power to move the prices and they are the ones you should trade with. The basic pattern associated with stock market is balance, imbalance, balance, imbalance, etc. And the market trades between an established excessive level until it trades above the high of the excess, that is a breakout above the resistance level, or it trades below the low of the excess, that is a breakdown below the support level. Now it may seem confusing, but we will clear it out as we move further in this video. So talking about a balance area, if the market is balanced, it means that there are equal amounts of buying and selling activities and the prices keep moving up and down within a particular sideways range. Now when it comes to an imbalance area, it is when the buyers or sellers are in control and the market is imbalanced and it will move in the direction of the predominant players. So if the sellers are in control, the market will move down, and if the buyers are in control, the market will move up. Now to understand this concept of balance and imbalance, let's move to the chart and see how we can apply these key points. As you can notice in the chart, the blue colored boxes show balanced areas, and these areas are areas where both buying and selling activities occur at the same time, or simply the supply is equal to the demand because both the buyers and sellers are comfortable around this particular price range. And you can notice the price move horizontally or in a sideways range. Now once the market moves from a balanced state to an imbalanced state, the price leaves the area with large candles, and this represents an imbalance, which means that one of the players, either the buyers or the sellers, exceeds or dominates the other. So on the chart we can see that the sellers exceeds the buyers and the prices drop with a very quick momentum and with strong candles. Once again the market enters a balanced state, waiting for the price to take a directional move to either the upside or the downside area, and this cycle will continue over time. So in general, the cycle of the market is associated with balance, imbalance, balance, imbalance, etc. So, in a supply and demand strategy, we will be focusing on spotting these areas of balance. The reason being, we want to place our buy or sell orders in these areas and we want to profit from the imbalance that will move the price in a directional point of view. But in order for you to trade the market imbalances, you first need to identify the supply and demand zones correctly. And to do that, there are a set of rules that you have to follow that will help you find these zones on any assets that you want to trade. But before that, let me talk about the different patterns associated with this strategy that we need to be aware of. Actually, there are two types of structures or patterns that we need to learn. The first type is reversal patterns and the second type is continuation patterns. So when it comes to reversal patterns, as you may already know, reversal patterns are chart patterns that are formed when the trend reverses its direction, that is from an up to down or a down to up trend. Now when it comes to reversal patterns, we have two structures. The first one is a drop base rally structure. In this structure, the price is moving in a downtrend, creating a drop in price, which is followed by a base structure and then a rally in the price towards the upside. The second structure associated with the reversal pattern is the rally base drop structure. So in this structure, the price rallies up and it creates a base structure and it is followed by a big drop in price towards the downside. Actually, these reversal patterns are very strong and the price tends to respect them over time. The second category includes continuation patterns, which actually signals a trend continuation. Here also, two price structures are formed. The first type is the drop base drop structure. In this structure, the price drops and then it forms a base structure and then it continues moving down, breaking through the base. And the second structure is a rally base rally. Here, the price rallies up at first and then it forms a base structure which will then continue moving up, forming another rally. Now, these continuation patterns are found inside the trend. And most of the time when the price tests these structures, the price tends to break through them. And that is why we will focus only on reversal patterns because they have good odds of success compared to the continuation patterns. Now with that information, let us move on to identifying the supply and demand zones on the chart following a simple 3-step process. The first step is to identify the current market price level. So this is the easiest step. All we have to do is to start off by identifying the current market price. The second step is to look to the left from the current market price to find extended range candles in the last drop or rally. So in this step, we need to find ERC type of candles. So ERC stands for extended range candles, and it is actually a candle that has a very large body with little or no wicks. So if the body's length is equal to the length of the wicks, it is not actually an ERC candle. And then we have to find the origin of the move. So once we have identified an ERC type of candle, we have either a drop or a rally in price. Now we have to find the origin of that move. The origin will actually form the base of our supply or demand zone. And the base is what we require to draw the zones, as we will see later on this video. Now let us look at an example of the entire identification process. So in this example, we will start at the current price and we will look to the left to find a drop or a rally in price with at least one ERC type of candle. And once we identified an extended range candle, we will have to identify the origin of the move. The origin is actually what we call the base. Now that we know how to identify the supply and demand zones, we need to learn how to draw our supply and demand zones. But before that, since the market these days is highly volatile and on most days we see the market gaps up or down in the morning, it is important to include gaps in our training. Market gaps are extremely useful price action structures that enables us to identify the supply and demand zones. So they can act as if they are indicators of the market imbalances, as they indicate clearly where the market is going so that we can trade accordingly. So from my point of view, gaps are actually leading indicators for trading supply and demand imbalances. So I have made a video on how to trade gaps from a price action perspective in my free price action trading course. You can check that out to know in depth about market gaps. So a gentle reminder, a gap is an empty space between two candlesticks where the price either rises or falls from the previous candle's close with no trading occurring in between them. What this represents is a big supply and demand imbalance where either the supply exceeds the demand or the demand exceeds the supply. This is extremely important for us as it shows exactly where the market imbalance is located on a price chart. So for your information, a gap up is a gap that occurs when the lowest price of a candle is above the highest level of the previous candle. Similarly, a gap down develops when the highest price of a candle is below the lowest price of the previous candle. Now when we talk about gap fill, a gap is considered to be closed or filled when the price comes back and fills the entire range of the gap. And once the price fills the gap, it generally reverts to the direction of the prevailing market trend. Now, based on the types of gaps, we can anticipate either the beginning of a new trend or a reversal of a previous trend. So in supply and demand, there are actually two types of gaps that are important to us. Number one is the professional gap and number two are the novice gaps. Now talking about the professional gap, it is a gap that occurs in the opposite direction of the prevailing trend. Take a look at this example. We have a professional gap that is formed in the opposite direction of the prevailing trend and the price retraces back to fill the professional gap and we can see the price reverses up from there. Now this kind of gap signals a market imbalance is created by professional traders and it gives us a great demand zone to trade once the price returns to fill the gap. Now the second category of gaps are novice gap. It is a gap that occurs in the direction of the prevailing trend itself. So a novice gap tends to form at the end of the trend, which will in turn lead to a reversal of the trend. For example, in this chart, it shows how the novice gaps are formed on the chart. You can see the price rallied, creating a gap in the same direction of the prevailing trend, but then suddenly it reversed back down. And as we have mentioned, novice gaps are located at the end of the move, and in the chart we can clearly see that the move ended and the price moved in the opposite direction. We can also notice that there is a zone where the reversal actually started. Now it is very important to understand these two types of gaps when trading supply and demand because they give us important piece of information as to where the market is willing to go next. And finally, we will now learn how to draw the supply and demand lines on the chart. In order to draw the supply and demand zones, we use two lines that we place around the base of the zones. The first line is called as a distal line and the second line is called as a proximal line. As I have mentioned, both these lines are placed around the base to form our supply and demand zones. The distal line is the outer line of the zone which is placed away from the current price, and the proximal line is the inner line of the zone which is placed near the current price. Now let me talk about a few things that you should keep in mind when drawing the supply and demand zones. The first and foremost thing is that you should have an idea about the structure of the base. The base must actually have less than 6 candles, and the candle's body should be less than or equal to 50% of the candle's total range. And the price leaving the base should have at least 2 extended range candles. And the base should not have the following things. That is, it should not have more than 6 candles. It should not only have doji candles. And we won't accept candles with very long tails or wicks. And we don't accept stair-step candles in our base. So there are reasons for this. For example, if the base has more than 6 candles or only has doji candles, we ignore it. The reason being, more than 6 candles and only doji candles can simply mean that the supply is equal to the demand and most of the orders are getting filled. Now, having less than 6 candles and not a lot of doji candles shows a great imbalance, and more unfilled orders are still waiting for the price to retrace back and fill them. So the zone will remain valid for them. Now what will happen if the base has candles with very long tails or wicks? It simply means that the level is a reaction to the previous supply or demand zone. Now these tails shows that the market participants went all the way down to look for unfilled orders, and they kept going back and forth until they got enough strength to push the prices higher. So most of the liquidity in that area would have already been absorbed. Also, a base structure that has a stair-step candles is actually a low probability zone. What I mean by a stair-stepping structure is that one candle is closing below the close of the previous candle in case of a supply zone, and one candle is closing above the close of the previous candle in case of a demand zone. Now when it comes to drawing supply and demand zones, there are a lot of different options to choose from, depending upon a person's risk appetite. In general, there are 3 methods of drawing your proximal and distal lines based on your risk appetite and how conservative are you in your trading. I will show you all the 3 methods that you can use to draw the supply and demand zones properly, and you can choose the right method that better suits your trading according to your risk tolerance. We have already discussed that supply zones can either have a rally based drop or a drop based drop structure. To correctly identify a supply zone, we have to start and leave from the current market price to find strong bearish candles with large bodies or bearish ERCs. In this chart, we can see the price rallied up in a nice uptrend and it paused for a short time, creating a nice base structure with a few candles. Then the price dropped, creating long bearish ERC candles, conforming to a strong market imbalance around this supply zone. And once you identify the zones you want to trade, you can now draw your lines around the base or the origin of the move. Now, as I have mentioned, there are 3 ways of drawing your supply zone. The first is the conservative method, where the distal line is placed at the highest wick of the base and the proximal line is at the lowest of the body in the basing structure. The second method is the high risk method, where the distal line is placed at the highest wick of the base and the proximal line is placed at the lowest wick of the basing structure. Now, if you decide to include both the high and low of the wick, you have in turn increased your risk by making your stop losses larger than it should be. Now the third method is the low risk method, where the distal line is placed at the highest wick of the base and proximal line is drawn at the highest body in the basing structure. So in a similar manner, you can draw the lines on a drop-based drop structure, but frankly speaking, I'm not a great fan of it. So I leave it up to you for the study. Now, as the price keep retracing back to the supply zone, we can take advantage of these retracements to place our trades around the base area. You will notice how the price retraces up and drops as soon as it approaches the supply zone without even piercing the proximal line. This means that large piles of unfilled orders are placed around the supply zone. Now, the idea is to place your orders and wait for the price to return and trigger them. Now, in order to identify a demand zone, we need to start from the current market price and move to the left to find a nice rally in the price or a group of bullish ERC candles and also a base with less than 6 candles. Now we are going to do the same thing as we did for supply zones, but in the opposite manner. We will start by identifying the basic structure to draw our zone. Then we draw the proximal line and the distal line using the 3 methods of drawing. In the conservative method, the distal line is placed at the lowest of the wick of the base and the proximal line is placed at the highest body in the basing structure. In the high risk method, the distal line is placed at the lowest wick of the base while the proximal line is placed at the highest wick of the basing structure. And finally, in the low risk method, the distal line as usual is placed at the lowest wick of the base while the proximal line is placed at the lowest body in the basing structure. Now, as the price keeps retracing back up to this demand zone, we can take advantage of these retracements to place our trades around the base area. And you will notice how the price retraces down and rallies as soon as it approaches the demand zone without even piercing the proximal line. This means that a large piles of unfilled orders are placed around this demand zone. And the idea is to place your orders and wait for the price to return to trigger then. And if you decide to include only the highest wicks for supply zone and only the lowest wicks for the demand zone, you are decreasing your odds of getting your orders filled by the market price. Now that is why we include a second line which largely improves our odds of entering into the position as well as keeping an eye on the risk factor also. Again, when drawing supply and demand zones, you have to keep in mind both your risk exposure and your odds of making money. Now when I talk about gaps are actually strong price action structures. So when it comes to drawing supply and demand zones that have gaps, it is important to know where we need to place our distal and proximal line. Now as a rule of thumb, we always draw our zones at the origin of the gap and not after it. That is, we place the distal and proximal lines at the highs and lows of the previous day's closing prices accordingly. Now we come to the most important part. How do we trade supply and demand zones? We buy at the demand zones and we sell at the supply zones. This strategy is pretty straightforward. All you have to do is to identify fresh supply and demand zones to trade. Then place your limit orders, either buy or sell orders at or beyond the proximal line and set your stop losses at or beyond the distal line. And then wait for the price to return to your supply or demand zone to trigger your orders. Now take a look at this chart. For the supply zone, the price rallied up, paused for a little while and dropped with big ERC candles. So we have a great imbalance at this price level. We draw our supply zone and we wait for the price to come back and retest this zone, and we also place our order. When the price comes back the second time into the zone, our sell order gets executed, and as you can see, it will be a great success. Now take a look at another example where the price dropped, then paused for a while and rallied again with big ERC candles, thereby creating a demand zone on its way up. Now we place our buy orders in the proximal line, expecting the price to return back to the demand zone to absorb the unfilled orders. Now each time the price tested our demand zone, it triggers our buy orders. We can see how the price is attracted to the zone like a magnet. Now there are times when you're not sure if the zone will yield a successful trade. So what you can do is to wait for the price to test the zone and give you some bullish or bearish evidence before placing your order. By that way, you could decrease your chances of entering a losing trade. Again, I prefer reversal structures for trading because they are powerful and the chances of success are high compared to the continuation trend structures. I hope you are familiar with the supply and demand curves and their relationship with prices. Now to identify the curve in charts, we need to look at the current price and identify the nearest supply and demand zones in control. Now the distance between the two proximal lines of supply and demand zone that we have identified forms the curve that we are looking for. So in the chart, we locate the current market price. We look up and down to identify the closest supply and demand zones that we have drawn. Now after identifying the curve, we can clearly see where the price is located. If the price is located near the demand zone, we say that the prices are low on the curve. When the prices are located low on the curve, our initial bias should always be to buy only. As the prices are low, the demand is always going to be high. So the price has a potential to move higher. Take a look at another example when the price is located near the supply zone in control. Here we only think of selling as the price is high on the curve, given the fact that the supply is expected to be on the higher side and that the price has the potential to move lower. Now, what happens when the price is located at half the distance, that is between the supply and demand zones? Now, in such a situation, we can trade in the direction of the prevailing trend. But I generally don't recommend this, as setting your stop losses becomes a hard task. In this condition, we say the price is at an equilibrium. We call it an equilibrium because buyers are equal to the sellers. Usually, the price keeps moving sideways in the area in the curve until one of the players exceeds the other. That is, if the buyers exceed sellers, we have an uptrend movement to the upside, pushing the prices higher on the curve. And if the sellers exceeds the buyers, we have a downtrend movement to the downside, pushing the prices lower on the curve. Now, you may ask me, why is it important to identify the curve in the first place? Now, this is actually what separates the winners from losers in the big game. The professional traders know that when the price is high on the curve, they need to sell to the retail traders who are actually excited to see an uptrend move continue. So the retail traders jump onto the trade and start placing buy orders. And professional traders actually use this high liquidity provided by the retail traders to actually short the market and move the prices even lower. Now, similarly, when the retail traders see the prices dropping very rapidly, they think this is a great chance to short the market. Once again, the professional traders jump onto the opportunity to place their buy orders as the price enters new low territories on the curve, signaling a nice bullish reversal to the upside. This is why it is important to identify the curve before placing any order. So as a general rule of thumb, we buy when the price is low on curve and at the demand zone, and we sell when the price is high on the curve and at the supply zone. So when the price is at an equilibrium, we either trade with the prevailing trend or we don't trade at all. With that, I end the first part of this 2-video series, and as I have mentioned, the next video is going to deal with odd enhancements and scoring, which will help you to better use the supply and demand concept and put it to good use with a higher probability of success in the market. But in the meantime, learn, backtest, and improve this strategy. If you learn something new, please do like the video, subscribe to the channel, and enable the bell icon so that you won't miss out on any upcoming videos. I will see you guys in the next video. Till then, see you.